As we conclude 2016, we believe investors should focus upon what we would refer to as the 4 E's. These are perspective on the U.S. election, the economy, trends in corporate earnings, and expected interest rates. As we all know, the U.S. has just concluded the election of our 45th president, and the surprise victory of Donald Trump has left the markets to ponder what sort of economic agenda his administration will bring forward. In this regard, we believe it is important, just like it has always been during presidential transitions, to put this change in proper context. While there is much speculation as to whether a Trump presidency will ultimately result in lower corporate taxes, greater fiscal spending, and higher inflation, all of which could well be the case, we would not recommend investing based on anticipated changes in government policy, and to remember history has shown that over the long term, markets will follow economic and profit cycles rather than political ones. The U.S. economy is poised, in our opinion, to grow at higher levels than the somewhat anemic 1 to 1.5% rate experienced in the first half of the year. With the initial third quarter GDP estimate coming in at better than twice that level, we believe there is a case for pent-up demand in the economy stemming from increasing wage growth, personal savings, and consumer spending, and these trends should provide a tailwind to the markets. Following a year of negative growth, we believe stock earnings could be setting up for double-digit improvement in 2017 as the energy sector benefits from recovering oil prices and once again contributes to overall corporate profits. A more stable U.S. dollar could also help exports for global companies. It is this potential transition back to positive earnings growth in the months ahead that has helped stocks to maintain near record levels and could propel them higher in the year ahead. Finally, in the recent days since the election, we have seen an uptick in interest rates as the market seems to be interpreting future Trump economic policy as more conducive to creating inflation. This has pushed the 10-year Treasury yield above 2% and to its highest level since January. At the current time, we most likely see a Fed rate hike at their upcoming December meeting, with longer-term interest rates somewhat range-bound at these higher levels for the immediate future. Clearly, economic and inflationary trends in the new year will certainly be an area of focus for the fixed income markets. Thank you for your time, and we look forward to providing you with future updates.